There has been talk of a looming recession for many, many years, and that talk has increased in 2022 going into 2023. The reasons for this recession could include supply chain issues, high inflation rates that have led the Federal Reserve to raise interest rates to 15-year highs, the slowdown in the economy that's predicted to bring about. Why matters less than how one should prepare for a recession. Some say we're already in a recession because we had 2 consecutive quarters of negative GDP, which at one point was the metric used to calculate a recession. But now it's the National Bureau of Economic Research that determines whether the US is in a recession. And it uses other metrics as well: payrolls, unemployment, retail sales, and many others. The argument against us currently being in a recession is that jobs numbers have remained strong. And so this is a very different situation than the 2008 crisis, as an example. But just because we're not officially in a recession doesn't mean one isn't coming. And humans generally are bad at predicting what's going to happen in the economy. So it's good to know what should be done if such a recession were to happen. Now, if you think back to the COVID crash, March, April of 2020, many people thought markets were going to continue to tumble for months and months and months. They quickly rebounded and reached all-time highs. If you acted on a whim, you might have sold everything, maybe at a loss, not known when to get back in, and missed out on an insane amount of investment gains. So that's why from an investment perspective, you don't want to be changing what you're doing if you think a recession is coming or because we are in a recession, big picture, okay? The first step always is, what is your asset allocation, AA? Based on your age, based on your risk tolerance, and based on your goals, figure out, how am I going to divvy up my different types of assets between cash, stocks, real estate, etc. We've done this many times before on different segments. You've got to figure that out. And that should be based on, again, age, goals, risk factor. Not, is there a recession coming or not? Because that's a form of timing, which I don't recommend people do. If you decide, here's the asset allocation, we're going to distribute or redirect a certain amount of every paycheck to buying index funds, you keep doing it whether the economy is strong or weak. You don't have to worry, are we in a recession or not? Is the market up or down? You figured out how much cash do you need in your emergency fund? What's the percentage that you want to be putting in your investments? And you're sticking with that. Sometimes people get emotional. They see stocks and assets plummeting during a recession. They stop investing. They sell at a loss, they find risky alternatives, etc. If you look back in history, recessions are sometimes the best time to continue investing, because just by getting back to the previous highs, you can end up with a 20 or 30% return. That's not why you keep investing. You keep investing because you figured out your asset allocation. But there is more room for money to grow once things are fully recovered. It's also probably a good idea not to look at your investment accounts too often. Seeing how much you're losing can be devastating psychologically. So another thing is limit, I guess, what we would call tracking. If you're in the right asset allocation, you're not planning on selling any of your stocks to pay for your everyday life, you don't really need to look every day at your investment account. And that's an important thing to consider because it can make you behave more erratically by looking daily. Now, aside from the investment angle in this, you might feel a sense of urgency if you believe there is a looming recession to get your financial affairs in order. And this is where we go back to our financial order of operations. So it's important to review financial order of operations. I call it FOOP. That's the abbreviation, FOOP. Make sure you have $1,000 as an emergency fund in cash. We have a video on this. Work your way to making sure you have 3 to 6 months of expenses saved in case you lose your job. Get out of high interest debt. That'll be a drag on what you can save. Consider how much a recession would affect your career. Some industries are more vulnerable to a recession than others, and develop a backup plan. So for, I guess, number 4 would be a sort of job risk evaluation. That's something good to do all the time. For example, I think about, are there technologies that are likely to replace people who talk and take calls and do videos and that type of thing? Is my job likely to be replaced by a machine? Are aspects of the job likely to be replaced by machines? It's not that I think it's imminent, but I want to be understanding what's happening. And it's good to always do that evaluation with your job. Refreshing professional connections, updating your resume, have a network, have job hunting tools, et cetera, et cetera. All in all, the US economy has been resilient over the years, but it has had serious recessions. And that is sort of part of the system that we have. Capitalist economies have recessions, they have booms and busts. And it's important to have a plan that allows you, when it happens, to think long-term and avoid making rash, short-sighted decisions.